Hello guys, welcome back to this video, to this YouTube channel rather. So we are going to look at the differences between smart money concepts, SMC, and supply and demand trader. So you're basically new into trading. You've been hearing about different trading styles like smart money concept, support and resistance, supply and demand, ICT. All those ones are covered here in this my trading channel. Just check the differences between and you are going to find all those ones. So in this video, this is the last comparison video. We are looking at the differences between smart money concepts and supply and demand. So smart money concepts, SMCs and supply and demand are both trading strategies used to analyze and trade the financial market, particularly forex, stocks, other assets like crypto, indices, metals, oil, soybeans, so on and so forth. So while they share some similarities in focusing on price movement as shown in this and institutional trading behavior, they have different principles and approaches. So let us break these differences, while I will also cover other insights of these trading concepts. Now eventually I will help you answer the question which is the most suitable. So this will be the last thing we're going to cover in this particular presentation, for especially for the beginner's perspective. So let's begin with the first one, which is smart money concept. So what is the focus of smart money concept? So SMC revolves around understanding how smart move, i.e. large institution traders, often called BFI, or big financial institutions like Citibank, JP Morgan, Chase, etc., operates in the market. It focuses on analyzing and recognizing footprints left by these BFI and aligning your trades with their action. So SMC traders believe that understanding the BFI's market footprints provides an edge over other retail traders that do not look at the BFIs. Now, what about the objective of smart money? The objective of smart money is simple. It is to trade in the same direction as institutional traders by identifying key levels and market behavior that indicates where these players are active. Now, there are key elements of smart money trading. So the first key element is market structure. I've listed them here, so you will be checking while I'm going through them, each and every one of them. Market structure involves analyzing the overall market movement. So traders look for breaks of structures and changes in the order flow or character to identify potential trend changes or continuation as demonstrated. So this is what we are going to explain both of these two concepts with. So start studying it. Now, what about the other element? There's other element of liquidity pools. So SMT traders focus on areas where liquidity might be trapped, such as above highs or below lows, equal lows, weak lows, and highs, trend line liquidity, support and resistance liquidity zones, and session liquidity. These are zones where stop loss orders and pending orders are clustered, and smart money might push the price to trigger these orders before moving in the desired direction. I'm going to explain somewhere here all of those. Now, there's another concept called stop hands. Now, SMC traders recognize the manipulation of price to trigger stop loss orders before the market moves in the intended direction of the smart money. If you're an ICT trader, you will understand that is what is called AMD cycle or manipulation zones, coupled with Judah swing, etc. Now, there's another part of SMC called fair value gaps, FVGs. So price gaps or inefficiencies that the market might feel as it seeks equilibrium, which SMC traders use to identify potential entries. That is this part. Order blocks, specific price levels where institution buying or selling took place. These are identified by sharp price movement, as price move away from a level indicating that smart money has entered the market. So there are so many here, and I can offer several definitions. So just about supply and demand, which is also part of it, by the way. There's order flow, order block, and fair value gap, market structure, liquidity engineering zones, I've said, break of structures, inducement, change in characters, chalk, and then we also focus on top-down analysis, whereby we look at 4 hours and daily, 4 hours, weekly, back down to the entry time frames, lower time frame, intermediate time frames, and higher time frame. Now we also have points of interest, or they are often referred to as POI. So surprisingly, smart money concepts include in its analysis supply and demand as the basis. So if you're using smart money concept, in most occasions you will hear them talk about supply and demand more often. If it's purely supply and demand trader, you won't hear them because they are not. It is not commonly referred here, as we are going to cover. Now, let us look at supply and demand trading. So supply and demand trading, the focus is that trading is based on the principle that price movement are driven by imbalances between supply, or the selling pressure, and the demand, buying pressure. It focuses on identifying zones where these imbalances are likely to cause price reversal or significant movement, and that is the focus of supply and demand trading. Now, what is the objective of supply and demand trading? The objective is that the objective of supply and demand is that trading is to buy at demand zones where price is likely to rise due to buying pressure, and sell at supply zones where price is likely to fall due to selling pressure, capturing the price movement caused by these imbalances. Now, what about the key elements of supply and demand? We have supply zone, demand zone, zone identification, rally, base rally, and base drop patterns. So supply zones are areas in the chart where selling pressure has historically outweighed buying pressure, causing the price to drop. These zones are usually found after a sharp move down, representing areas where institutions have sold off their positions. What about demand zone? Demand zones are areas on the chart where buying pressure has historically outweighed selling pressure, causing the price to rise. These zones are typically identified after a sharp move, indicating strong buying interest. Now, what about zone identification as a concept, as a key area? Now, supply and demand zones are identified by looking at areas where the price has made significant movement or the impulse movement and then retraced to it. These levels are marked as potential entry for future trades in that particular overall direction. Now, there is what is called base rally and base drop patterns. So base rally and base drop patterns. A base is a consolidation area, somewhere like here. Rally is that the initiation price. So when price tags, I'm going to explain this. So a base is just a consolidation area before a strong move up, rally, or down, drop. The base is the zone of equilibrium before an imbalance creates a significant move. Now traders look for price to return to them these bases as potential entry points. So let's analyze this thing and see. Overall, anybody who trades supplies and demand, they are almost the same in the sense that we are all looking at market break of structures. Like in this case, the market is done downtrend and then it reaches a point, it changes character. So for supply zones, if you want to know supply zones, just know that supply zones are the same as supply and demand zone are the same as order flow zone, OFs. So it is the last buy before the sellout in a downtrend trending market, like in this case. So the same zone is always order flow for the SMC. Now when the market pulls back again to it, you are going to buy. So that is where now smart money and you are going to sell rather. That is where smart money and supply and demand meet, whereby both of them are looking at the same thing but in different angle. So supply is here, at the same time order block is here, fair value gap is here, and order flow is equally here. There is also an IDM taken, this price movement that is always 50% price action or price pullback that caused the break of structure. Most likely it's always an inducement zone. So when market reads it, it taps higher time frame, supply zone, order flow, and then it drops. So this is what is called a base, then a rally. So you're expecting that if price comes back to it, it should this is a base, then a drop. So when price comes back to it, it needs to drop again, and that is what you see here. Now this base dropped, but it failed to hold the price because smart money identifies it as IDM. So if you're only trading supply and demand, you may take this and you get a stop loss, while SMC would wait for this area to be raided by weak, or if it is full body, it should reach some order flow or supply and demand region, and then market drops. Now in smart money, there's a concept called SMT, or smart money traps, where smart money traders who don't understand the market well will try to look for trade in an area where their liquidations, where their orders are going to be liquidated because the market is having a weak high or a weak low. Like in this case, this is a break of structure and the market is on a downward trend, and therefore this becomes a weak low, so it should be raided. So you cannot buy here because you will be assuming that this would be a change of character. Of course it works in some occasion, but in most occasion you will just be liquidated and turn to other liquidities. Now there's another base here and then a drop. So for the supply and demand, this would be identified as a base. Now for the smart money concept, this would be identified as an order flow, and within this order flow there is order block and there's fair value gap as well. So when price returns to it, especially on order block and fair value gap, price is expected to drop because this is a base drop, retracement to the base, then another drop. Smart money may consider it as a range, initiation, mitigation, continuation. So we have a range, initiation, mitigation, continuation. That is smart money concept. Now for the ICT, they will conclude that this would be some AMD circle, like sort of. Now we have again break of structure. Market engineers another liquidity here. So some people will be trying to short from here, and then the market takes them out, taps onto something like fair value gap or point of interest, then it drops. Now if this is the base, this is the rally, it should mitigate and then continue upward, but overall the market is bearish, so most likely it may not work. Sometimes it may work. That is for the supply and demand. Now we have another break of structure, and then market shifts here, change character here. So this would be an IDM for true market structure, and this now will be change of character. Some will consider this change of character, especially if it pulls 50%. If this pullback was 50%, this leg here, this would be change of character. So we are expecting that this would be now the base rally for supply and demand, and then when we come back, we retest the base, it should rally again, and that is what you see. Now supply and demand, SMC would consider this whole of this movement, this last sell before the buy, as order flow. So when market taps on the order flow, you need to now check for high probability order block and fair value gap, as you can see here. An example of high probability order block is that it has taken liquidity and it has sufficient imbalance. If you want to learn more about high probability order block, fair value gap, supply and demand zones, you can just check in this channel. You are going to find those videos. Just search for them, high probability, or just check onto this playlist. You are going to find them, as I had already explained them in details at individual level. So that is how the market moves. Again, it comes back here. So this basis or order flows turns to demand if it is on the opposite direction. So when the market taps onto them, we are expecting price to rally upwards, because we're having a base rally. So price should tap on them and then move forward. So this would be IDM. So if you are out of state or out of flow state, you would mark this as a supply zone. This would be your supply zone, and you expect the market to respect it in the sense that that you had a rally, a base, then a drop, then you're expecting a tap and then a continuation of drop, and that does not happen because the overall order flow had already shifted to bullish sentiment, because it had already tapped on some higher time frame point of interest like order block, supply and demand in higher time frame, assuming that this is 4 hours. So these entry points at order block, fair value gap, demand zone, supply and demand areas, all of them are done with top-down analysis, assuming that this is 4 hours. These lines you are seeing here is 4 hours. So at 15 minutes here, you look for the same thing and you're going to find change of character. Then you write this move upward. Same to here, same to here, same to here, and then same to here. So that is what is all about top-down analysis in smart money concept. Now, with that simple explanation of them, so let's look at the differences that emerges from these two. So the differences are mainly categorized into 5 major areas. So the first one is conceptual foundation. So SMC basically centers on idea of tracking smart money and institutional behavior. It looks at market manipulation, liquidity hunts, and other order flow to align with large players. However, for the supply and demand traders, they base on economic principles of supply and demand imbalances. It focuses purely on price action and historical behavior at certain price level, assuming these zones will act similarly in the future. That is why we have a base, a rally, a base, a drop, and then a retest. Then it should act in the same manner. Another difference is on the focus on the market behavior. Now SMC more intricate are more intricate and involved in understanding how and why smart money manipulates the market. It includes a detailed analysis of liquidity, order blocks, and fair value gap, as I indicated here. Now what about supply and demand traders? They are more straightforward, focusing on price movement and patterns to identify zones of interest. It doesn't necessarily consider the motives behind price movement, but rather the results of supply and demand imbalances. So basically, there are other differences based on zone identification, tools and techniques, as I've explained here, and then there's also market manipulation. Now SMC acknowledges and tries to exploit market exploitation by institution. Traders look for patterns and suggested manipulation zones, e.g. stop hands, and align trades with institution. Now what about supply and demand traders? They generally does not factor in manipulation as a primary element. It assumes that price action and balance of supply and demand will dictate the movement of the market. So the bigger question is, which one is the most suitable for beginners? What I want you to know is that regardless of the trading style you choose, they are all derived from the simple principle of supply and demand, and this can be knowingly or unknowingly, and that is why in any market, either physical or online, if people don't need that good, it lacks demand, and so people will not buy, and the suppliers will not supply the same item. So all trading concepts are based on the laws of availability, of demand followed by supplies, and vice versa, as I have explained in this trend. So for beginners, supply and demand trading is generally easier to understand and implement. It's based on the intuitive concept of buying low and selling high at identifiable zones, and does not require deep knowledge of institutional trading behavior. So this one is the most recommended. Now, when you become an advanced trader, smart money concepts offer a more sophisticated approach and can provide you with a deeper understanding of market dynamics. For any trader who is looking to gain an edge by understanding and trading alongside institutional players, smart money is recommended. So SMC provide a powerful framework for that level of understanding. However, you will need more time to understand fully SMC.